In this week's video, we'll discuss navigating in indecisive stock market waters. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. In recent weekly videos, we've been covering indecisive charts, and in particular, indecisive weekly charts. Before we start this week, it's good to have a visual of what extremes look like. If we understand extremes, it's a lot easier to understand everything that falls in between. So as we go through the weekly charts, or any chart for that matter, this is a low probability look. I can see that price is below both moving averages, blue is below red, and the slopes of both are down before really bad things happen in 2008. Conversely, on the weekly chart, I can see in March of 2009 that price is above both moving averages, blue is above red, and the slopes of both are up. So as we go through the charts this week, if you're new to the fold, you might want to come back and revisit these visuals. Clients and regular viewers know that we've covered numerous rare market statistics that have occurred over the past 2 years or so. Here's another one that may be coming soon. This is the SP500 Weekly here. This is the year 2014. This is the present day here. If the S&P 500 goes on to make a new high, it will be the first time in the 120-year history of the U.S. markets, and that's based on the Dow Jones Industrial Average, that we've had a correction or market profile like this in terms of duration, and then we went on to make a new high. Simplified, it would be the longest stock market correction over the last 120 years. Thus, we are in a very, very rare period. One of the ways that we can handle that, and one of the ways that the model handles that in terms of the rules, is to simplify using the if-then approach. The present day looks similar to this situation here. Here we have a sharp rally, and in this case we never go on to make a higher high. Now we have an indecisive market here. One of two things will happen in the present day. Either we'll rally to new highs here, or this will morph into something that looks very, very similar to last year. One of the ways that we can minimize, not eliminate, minimize the probability of being whipsawed is to use that if-then approach. From an anecdotal perspective, this allows us to see how that might work. The data has improved here. The data has improved here. If we were using an if-then approach, the market from a weekly perspective never went on to print a higher high, and the hurdle would not have been cleared, and we would have not have scaled into stocks. In this case, we'll let price decide. Price will decide if we continue to scale in or we stop and move back to the do-nothing alternative with our cash. A logical question might be, why are the rules treating this rally differently than this rally? Well, there's two primary reasons for that. During this rally here, the evidence behind us here tells us that the primary trend is up. The primary trend is up until proven otherwise. When we move off of this low here, that's no longer the case. It's not clear that the primary trend is up when we're at these lows here from a mathematical perspective. That's one significant difference between this low and this low. The other significant difference is we have evidence here that the market was indecisive in this area, and this is Whipsaw City here. It's the recent past. So when we come up here, we understand that it's possible that something similar would happen, and the implementation rules adjust to try to minimize, again, minimize, not eliminate, the probability of being whipsawed. the implementation rules are adjusted for different market conditions, and they adjust primarily based on the primary trend. Implementation is different when the primary trend is up versus a situation where the primary trend is either unclear or appears to be rolling over and is now down. Another method that we can use to simplify our approach during a period of long-term consolidation is to take a step back and understand that if we have a game plan for the extreme cases, we can probably handle almost everything in between. Therefore, do I have a game plan if the S&P 500 moves to 2340? Conversely, do I have a game plan if the S&P 500 drops to 1680? In our case, the answer is yes. And when you have a game plan for that, it's much, much easier to maintain your composure and to sleep well at night. Any game plan where you put something on paper from an if-then perspective can help. This is a monthly DeMark chart of the S&P 500. DeMark charts and indicators are proprietary tools from Market Studies, LLC. Over the past 5 trading sessions, some of the if-then levels for the model were hit, and that's the first time they've been hit in quite some time. So right there, that tells us something may be different and something may be improving from a probability perspective. This is the broad NYSC Composite Stock Index a week ago on Friday, May 20th. This is a weekly chart. This is the close here. So basically, we had a rally intra-week here. This is an indecisive doji look here. We closed roughly at the midpoint for the week. Sometimes that can signal a reversal. If we fast forward 5 trading sessions to the close on Friday, May 27th, we can see that the closing price here exceeded the close for the last 1, 2, 3, 4 weeks. That's quite a bit different than what we had seen in here, and we also closed near the weekly high. That just speaks to probabilities. It doesn't mean we're going to go on and make a new weekly high, but unquestionably this chart looks better than it did 2 weeks ago or even last Friday. Another example of observable improvement over the past 5 trading sessions. This is the NYSC Broad Composite Stock Index daily this time. This is Friday, May 20th. You can see that this is a vulnerable look here. We've got white space below, and we have a lot of white space below. This looks like a bullish breakout and then a failed breakout. If we fast forward 5 trading sessions, we can see that price has recaptured 1, 2, 3 of these lines. We still haven't gone on to make a higher high yet, and that would be another form or if-then type scenario from an anecdotal perspective of how we can remain patient. If we're going to rally for 6 months or 6 years in this direction, it's not mathematically or physically possible for that to happen unless we first exceed this high here. This is our long-term weekly NYSC composite dating all the way back to 2006. Where my cursor is, here's the peak here in 2007 at 10,301. A week ago on Friday, May 20th, we closed below that level. If we fast forward a week, we can see that we've now recaptured it. The close was 10,466, which is above 10,301. All we really know right now is that the market believes that this is an important area. You can see resistance, support, and then we've been hanging around that general area here. The further we move away from 10,301 in either direction, the more relevant it becomes. If we move in this direction here, the further we get away from it from a magnitude perspective, and the longer we stay above it from a duration perspective, the more meaningful it becomes. The same can be said for a move in this direction. Thus, we're near that inflection point, even from a very long-term perspective, and we'll learn something either way. Price has not made a decision here yet. It's still in indecisive mode. We'll cover this in another area a little bit later, but you can see it here. An inverse head and shoulders pattern is a probabilistic bottoming pattern that occurs after a decline. Watch my cursor here. This is the left shoulder. This is the head. It's much bigger than the shoulder. And then this would be the right shoulder here. It's bullish when you break above the neckline where my cursor is here. It's possible that we have a similar situation. A decline. Here's my left shoulder here. This is my head here. And then I've got a right shoulder here. That's one of many possibilities. And basically you get a shakeout in fear here, a big spike in fear here, and then one more shakeout of fear here before price moves higher. If we're paying attention to price and using the if-then implementation rules, it really doesn't matter if this is an inverse head and shoulders pattern, but it does help us keep an open mind about bullish outcomes. This is the box that we've been watching. We said we would learn something if price moved above 2084 and change, or if it moved below 2039 and change from a short-term perspective. Last Thursday here, we did break out of the box, but it turned out to be a failed bearish breakout. And often when you see a failed breakout, you get a relatively sharp move in the other direction. You can see as of last Friday, May 20th, we still, even on the 60-minute chart, have a very, very clear and discernible downtrend. This is a low, this is a lower low, a lower low, a lower low. This is a high, a lower high, a lower high, and a lower high. Now, if we fast forward 5 trading sessions, we can see that we have now broken that short-term discernible downtrend here, and we moved all the way from the bottom of the box on Thursday, May 19th, and on Friday, May 27th, we closed above the box, and we also closed above this rising pink channel here. The longer we stay above the box and the longer we stay above the pink line, the more relevant it becomes, and that applies to magnitude in terms of the percentage move and duration, days, weeks, months, and years. This is a good example of that. We moved out of the box for a very short period of time, and the magnitude of the move below the box was relatively small, meaning when we're down here, this breakout is not really that meaningful, or this breakdown, until we see that it holds. In this case, it did not. Another reason for using the if-then approach here is the market still has hurdles to clear. So we don't want to take all of our cash and redeploy it until the market can prove some things to us. S&P 500 daily, this is last Friday, May 20th. You can see we closed below this red line, and this blue line here. The same chart 5 trading sessions later on Friday, May 27th. We have cleared some hurdles, but we still have some hurdles above, and the market still has to prove to us that it can clear them. If we're going to rally in this direction for 3 weeks, 3 months, 3 years, or 30 years, we absolutely, positively have to clear these lines first. The longer we hold a breakout like that, the more meaningful it becomes. And obviously, the scenario where this acts as resistance and the market fills white space is still on the table. We're starting to see some evidence that this rally here might be a little bit different than this rally here. And of course, this rally here failed. This is the weekly chart that we've been looking at, Friday, May 20th. Same chart on Friday, May 27th. Unlike this period here and this period here, we had a weekly close above this dotted line, which is a hurdle that has now been cleared. The more hurdles that we clear, the higher the probability something good will happen. 3 or 4 weeks ago, when things didn't look very good, we said the world can't end until we close below this blue line here. That's a form of an if-then type discipline. We did break below the blue line intraday, but it held last week. This is Thursday, May 19th. This is what it looked like on May 20th. Same chart as of the close on Friday, May 27th. We were able to clear this downward sloping trend line here. We always want to keep an open mind about all outcomes. In this case, obviously, we have some hurdles to clear and some things to prove in this direction here. Also, you can make an argument that this is bullish because price here, where my cursor is, made a higher high than this high here. And that is true. That's a good sign. However, we did the same thing over here. This daily high here is higher than this point here. So we have to keep an open mind about the market deciding to fill white space in this direction. That's one of the reasons why we still own some defensive positions and we still have cash in the portfolio. The market will decide for us in terms of how our allocations change in the next few days, weeks, months, and years. The model, of course, tracks hard data and asks binary questions. This is the S&P 500's 200-day moving average. You can see last week the slope was down. If we fast forward to Friday, May 27th, you can see that it's trying to turn back up here. Is this a big deal? No, it's not a big deal. But if it's going to turn back up, it eventually has to flatten out. And it looks like it's starting to try to flatten out. And this aligns with our indecisive inflection point period. From a bearish perspective, we have improvement. Mathematically, in the 200-day here, it didn't really seem to help. But if we're going to rally for 3 weeks, 3 months, or 3 years, we pretty much know that this 200-day is going to start to look more like this higher conviction and lower risk period over here from a mathematical perspective. The closing price version that we've been watching Friday, May 20th, this is not a confidence-inspiring look at all. We broke below this blue line here and even closed below it during the rally or after the rally on Friday, May 20th. Really haven't done anything impressive on this version of the chart. Friday, May 27th, it still doesn't look great. It still has work to do, but it looks a lot better than it did a week ago, and we have cleared some hurdles here, and we were able to hold them on a closing basis. This is the chart of the VIX that we've been covering for several weeks here. We know from a historical perspective, short-term historical perspective, that when the VIX held here in July of 2014, and when the VIX held at this blue line here in the July-August time frame, that helped us with probabilities in terms of having the stock market reverse and fall in these two anecdotal cases. This is the VIX last week as of May 20th, and we've been saying that if you're a bear, you would prefer to see the VIX move in this direction if you're a stock market bear, and if you're a bull, from a probability perspective, a stock market bull, you'd prefer to see the VIX close below this blue line. If we look at the same chart as of the close on Friday, May 27th, we did close slightly below it, but we've closed below it for 1 day, and from a magnitude perspective, we're very, very close to this line. So this is meaningful, but it's not that meaningful yet because we're still near that indecisive blue line. The further we move away from it and the longer we stay below this line, the more meaningful it will become. This is helpful, but we still have to keep an open mind, and this does look different than it did here and here. Wilshire 5000 Composite Stock Index Weekly as of the close on Friday, May 27th. Here's an example of something that makes this rally look a little bit better than this failed rally here. We have a bottom, a sharp rally, a reversal, and a second attempt at making a new weekly closing high. In this case, we weren't able to do it. We have a sharp rally, a reversal, and a second attempt at making a new weekly closing high. This week, we were able to do it. This is a subtle and bullish difference relative to this lower weekly high here. We can make the exact same argument for the S&P 500 weekly lower high, higher weekly closing high. In this case, you get a whipsaw here from an if-then perspective. The if, a higher weekly closing high, anecdotally, if that was our if, was not ever met here. In this case, if we have an if-then situation, it could help us avoid or reduce the frequency of whipsaws. S&P 500 weekly as of Tuesday, May 24th. We have not yet made a higher high relative to the first high. Why are we exercising some patience in here? Well, in this case, we weren't able to make a higher high, and the market failed and corrected sharply in the other direction. This is the Indecisive weekly chart now as of the close on Friday, May 27th. You can see we've been hanging around this line here. Resistance, price was rejected, resistance, price was rejected, resistance, price was rejected 3 times. Here, we came up weekly close above number 1, weekly close above number 2. Now we have weekly close above number 3. We've also moved from a full bore bearish look here where price is below both moving averages, blue is below red, and the slopes of both are down. And now we're back to a full bore bullish look where price is above both moving averages, blue is above red, and the slopes of both are up. The longer this look stays in place, the better. We're still near the blue line, so we have to respect that we still could see something that looks similar to this period here. Right now, if we're trading the chart that's in front of us, this chart looks a lot better than it did down here. Another example of observable improvement, Nasdaq Weekly. This is Thursday, May 19th. We have the full bore bearish look. Fast forward to May 27th, Friday's close on the holiday weekend, and we've now flipped back to a full bore bullish look. We still are nowhere near making a higher high. So the Nasdaq still has some work to do, but the odds look better today than they did down here. Last week when we looked at this chart, we said it had a more vulnerable look here than it had here. And we also said it was possible that this was a second retest at the blue line. What once was resistance, what once was resistance, what once was resistance may now act as support, may now act as support. Same chart, close on Friday, May 27th, looks better. We have not cleared this high here, so that's a hurdle that we would like to see cleared. We were able to move back to the full bore bullish look, but we're still near the blue line. Small Caps Weekly, Thursday, May 19th. You can see this is somewhat of a concerning look here. Resistance, resistance again here on the weekly chart. Resistance, bullish breakout, what looks like a failed bullish breakout. Fast forward to the same chart as of the close on Friday, May 27th, and we have a much improved look, but we're still near the blue line. We'll learn something either way. Weak dollar assets, Yellen boosted assets, whatever you want to refer to them as, have been some of the leaders off of this low here. This is something that we would like to see resolved in terms of the mix for our portfolio going forward. This is materials, a weak dollar friendly asset relative to the S&P 500. The ratio resistance, resistance, resistance. We're in that same general area here. If this breaks out in this direction and holds, then weak dollar assets are probably going to be a good place to be. If the ratio starts to fall back in this direction, they're probably better places for our capital over the next few weeks or months. Globally, have we seen some improvement? The answer is yes. Global stocks daily here. You can see we're making a series of lower highs and a series of lower lows on May 20th. This week, we were able to break that trend, and we made a higher high on a closing basis here. That's a baby step, but it looks better than what we had here. Where do we stand relative to the retracements we've been watching? Last week, Friday, May 20th, price closed near the 50% retracement here. A week later, on May 27th, we're still in that indecisive area, but it looks like we're trying to make a stand at that logical 50% level, and now we're starting to approach the 61.8% level. We'll learn something either way if price moves in this direction or if it decides to move in this direction. If we look at the before here, this is the NYSC Weekly as of May 13th. This is starting to look similar to this period here that did not end well in the equity markets. The broad NYSC Composite Weekly here, this is last week, Friday, May 20th. You can see in this case we have a full bore bearish look. Price is below both moving averages. Blue is below red and the slopes of both are down. Is that a convincing full bore bearish look? No, it's not. The math says that it could reverse. That's an indecisive look. If we look at the same chart using the same moving averages on the same time frame, Friday, May 27th, now our indecisive look has flipped back the other way. We can also make that argument that this is a decline here, and this looks like we could have a probabilistic bottoming pattern forming here in the form of an inverse head and shoulders. This would be our neckline here. Price is here. We're still below this neckline. This inverse head and shoulders is not used by the model, and if we're using the facts and we're using if-then situations, it really doesn't matter whether or not this is an inverse head and shoulders, but it does help us keep an open mind about a move in this direction, and also helps us keep an open mind about the potential for a relatively big move in this direction. This pattern becomes more meaningful if we can clear the neckline here, and that has not been done yet as of Friday, May 27th. We'll learn something either way next week. Common sense tells us that if the S&P 500 moves to 2340 on our monthly DeMark chart, or if the S&P 500 drops to 1680, discernible improvement or discernible deterioration will occur within the data and on the charts. Therefore, if we keep a flexible and open mind, when the data starts to either improve or deteriorate, it will increase our odds of capturing either a big move in this direction or a big move in this direction. Why is that important? When we're in these indecisive periods and near a 61.8% retracement as we are today, we can get bullish resolutions and bearish resolutions. These are big moves. How big are they? In the 2008-2009 case, or the bearish resolution, the S&P 500 dropped 56% from that 61.8% retracement. You can see what that could do to a portfolio. In the bullish 2011-2012 case, when we moved away from the 61.8% retracement in a bullish manner, a 44% move followed that difficult and indecisive period. Therefore, when we see charts and risk-on, risk-off ratios, and the numbers in the model start to improve, then we have to be open to that improvement. Dow, here's an example. Last week, May 20th, the 200-day moving average, we said this is somewhat of an indecisive look. Fast forward a week, and it's starting to turn back up. Is this a big deal? No, it's not a big deal. But if this morphs into something like this, and the S&P 500 starts to move to 2340, the only way we're going to be able to comprehend that type of change or that big of a reversal is to maintain that all-important maximum flexibility. The way that we do that is to keep that flexible, unbiased, and open mind. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.